Thank you for joining us at xm.com. You're watching today's market comment by Haralambos Pisuros. I'm Cristina Marujas. The dollar traded higher against all the other major currencies on Tuesday and continued trading on the front foot today as well, with the dollar index hitting a fresh 10-month high. It seems that the Fed's higher for longer mentality is still adding fuel to the currency's engines, as well as lifting Treasury yields, with the 10-year benchmark rate jumping to a new 16-year high on Tuesday, on the back of data pointing to a resilient economy that can withstand more interest rate increases. Despite hawkish comments from Fed officials, the market assigns a less than 50% probability for another quarter-point hike before this tightening crusade ends, while it sees interest rates ending 2024 at lower levels than last week's dot plot suggested. This means there is still room for upside adjustment and thereby further advances in the US dollar. The next focal point for dollar traders may be the core PCE index for August on Friday, which is expected to have slightly slowed to 3.9% year-on-year. Although this could result in a pullback in the greenback, it is unlikely to change the broader outlook. Dollar yen is extending its uptrend as Treasury yields continue to rally at a time when the Bank of Japan is keeping a lid on its own government bond yields. With that gap widening, the pair emerged above 148.85 and could continue higher for a while longer as the Bank of Japan appears in no rush to adjust its policy soon. However, the higher the pair goes, the higher the probability for intervention grows. According to market chatter, the round number of 150 may be the line in the sand that could trigger action, but with warnings not so frequent as last year, that intervention level may have moved a bit higher. However, the gap between US and Japanese yields may continue to widen, which means that any declines in dollar-yen due to intervention are unlikely to be permanent. All three of Wall Street's main indices ended Tuesday in the red, losing more than 1% each, as the Fed's hawkish outlook on interest rates continue to exert pressure, especially on high-growth firms. That said, the outlook of interest rates is not the only driver of equities. Fears about the performance of the Chinese economy are also weighing, while the prospect of a new government shutdown in the US may be a new source of uncertainty. The US Senate voted to begin debating on a measure that would fund the government and keep it running until November 17th. However, the Republican-controlled House seems unwilling to support the Senate's proposal. If no common ground is found this week, government shuts down on Sunday for the fourth time in a decade. Thank you for watching today's market comment here at xm.com.